When we consider fair value for the Australian dollar, commodity prices and the level of interest rates in Australia versus elsewhere in the world are always front of mind. Currently, commodities, particularly iron ore, are a big positive for our currency. Relative interest rates are meanwhile a neutral to modestly supportive factor, given most developed nations are at their respective lower bounds of policy and are expected to remain there for quite some time. Another important factor is sentiment or risk appetite. This can be assessed using volatility indicators for equities and currencies, but as the data becomes available, is best understood through an assessment of global capital flows. For Australia, the ABS's balance of payments release for the March and June quarter provide this context. It is inevitable that in a time of crisis, repatriation of funds to home jurisdictions will occur. Portfolio investment flows are particularly fickle, typically being the result of in-the-moment investment decisions in liquid assets such as equities and bonds. In the March and June quarters of 2020, domestic investors repatriated funds previously invested in listed equity and liquid debt investments abroad back to Australia at a 60 billion annualised pace. Foreign investors, meanwhile, sold down their holdings of liquid Australian equity and debt assets at an annualised pace of about 180 billion, then 100 billion in the June quarter. Also, while deposit and loan holdings saw an inflow in the March quarter, this flow reversed fourfold in the June quarter. Each of these flows individually reduces available capital for real and financial investment in Australia. However, in the June quarter, these outflows were offset by inflows from a record trade surplus and the RBA selling down foreign currency assets and buying Australian dollars. These inflows stabilised the Australian dollar in the low 60-cent range against the US dollar at the beginning of the period, and at least in part fueled its run to around 69 cents at the end of June. In the September quarter to date, the Australian dollar has moved higher still to around 73 cents. We don't yet have capital flow data for this period, but some of the detail from the March and June quarter releases highlight the investor activity that is likely continuing to support the Australian dollar. While net direct investment into Australia slowed dramatically in the June quarter, the inflow was still positive. There was no evidence of forced sales or a repatriation of funds from domestic subsidiaries to foreign parents. That this sanguine response to the crisis follows 8 or so years of strong direct investment inflows into Australia emphasises foreign investors' commitment to long-term investment in our nation. Portfolio equity inflows also pointed to foreign investors' confidence in Australia's outlook, with additional funds placed here through the 6 months of June, despite the uncertainty related to COVID-19. The greater our suppression of COVID-19, the stronger our domestic economy will be, and the deeper our economic ties to nations where the recovery prospects are greatest and most probable, namely Asia, the more foreign investors will look favourably towards our exporters and the regions in which they operate in Australia. Both dynamics will entice investment in Australia, financing construction and employment in our real economy and supporting our financial markets. This is a key reason why we believe the Australian dollar will rise to around 80 cents against the US dollar by the end of 2021. See you next week.